And of course, we're still watching this market sell-off that's going on cross-asset, just incredible moves here. Stocks down. We've got Treasury yields below 1% across the board. Joining us to discuss all of this is Jefferies chief market strategist, David Zervos. It's great to have him in studio to get some insight into what the heck is going on. You wrote a note, I believe yesterday, where you talked about the possibility that the Fed's going to have to come in here and do another move. It did expand its repo facility this morning. Is it going to have to do more, and what does that look like?
Well, it did. It did about $75 billion, so $50 billion in the short and 1 day and 25 in the longer day. So that's a reasonable amount of not QE, if you want to call it that. But yes, I mean, it was really a follow-up to what we wrote last Sunday, which was go big and go early. This was kind of go bigger and go earlier. And I think, we were looking for something intermeeting last week. And I think it's really just a question of how we go into these weekends and we just get more and more data that's more and more dire. And I just, there's not a lot of reason for the Fed to sit back when it sees that kind of data, not just on the virus, but also on the markets freezing up, the high yield debt markets, and what's going on in credit.
We even had Eric Rosengrant has raised the possibility that Congress could authorize the Fed to purchase a broader set of assets and securities other than the government guaranteed bonds currently permitted. Do you see a day, we had a guest on in the last hour who said maybe the Fed starts buying corporate debt. Do you see them moving into a lending facility that would start doing that?
I think a lending facility is super easy. The outright purchase of, not so easy. That would take an act of Congress. That would take opening up the Federal Reserve Act. Right now, the Fed can buy mortgages, treasuries, and some shorter dated municipal securities. Those are the only three outright purchases they can do under the Federal Reserve Act. Under the 13.3 structure, which is what they put into place in 08 and 09, they can lend against anything. So if we walk up with, 5,000 small business loans all packaged up, deliver them to the Fed can fund those on a term of 1 year, 2 years, 3 years, whatever term they like. And that's sort of what we saw with the CP market last year, last crisis in 08. We saw that with a number of other distressed markets. So I would certainly expect that that's a possibility, although it's also likely to come just through the Treasury as well. It's not clear that the Treasury couldn't act in that way without the Fed.
As you mentioned in the note that the Fed, if they cut again, and of course they're already running low on ammo, but they're going to be running even lower when it comes to what they have in terms of their tools when it comes to rate cuts. What do you make of the efficacy of another rate cut? What do you think that would do for markets? Would it actually be helpful?
I don't think any of these things hurt. The cost of doing a rate cut, the cost of reigniting QE, the cost of doing what you were talking about, the funding facilities, is that we overstoke the economy and create some unwanted inflation pressures. That's the cost of a monetary easing. And right now, with oil down where it is, the idea that we're stoking unwanted inflation pressure seems pretty ludicrous, not to mention that for the last 8 years, the Fed has missed its PCE inflation target by an average of about 70 basis points a year. So they're way undershooting inflation. They have been all the way through this recovery. I'm not sure what the cost is, although there are a few that say, hey, there's financial stability risks. You may be stoking stocks. Well, we were at 3,400. Now we're at 27 something. Doesn't feel like we're stoking stocks too much when we're coming in after such a big, significant pullback, especially with the credit markets in seizure.
Do you think today, the action we're seeing today is panic selling? And then if so, do you finally start to see some bottoming, at least from a short-term perspective, bottoming out in the market, let's say into the close today?
Look, the short term is impossible. Anybody that comes on your show or any of the other shows out there and says, I've got the bottom, it was Howard Marks one of the other days, so how do you define the bottom? And I think he said, it's the day before things start going up. And I thought that was a great quote. Nobody knows. What we do know is that valuations look a lot more reasonable. Relative to where interest rates are, valuations look even more reasonable. And the reality is, this is not some fundamental problem with the economy. This is not that we woke up one day and realized our entire mortgage market was a fraud, or our entire telecom market was a fraud, or that, Enron was a fraud. Or this is one day we woke up and there was a natural disaster. This is much more like a 9/11 than it is a sort of fundamental flaw in market structure. So I think in that sense, it's just much easier to think that we get through this with an economy that is robust in the end once we figure out what this virus really means.
David, that is a perfect segue. We want you to stay with us because we can continue this discussion. This is not 2008, 2009 when the Fed needed to intervene and get money out there in the same ways that perhaps they need to act now.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.